Hi everyone, we'll just give people last sort of 30 seconds or so to join up, and then we'll be on our way. Hi everyone, so hope everyone's well and keeping safe, and trying to enjoy and keeping a positive spin on the lockdown. I know that a lot of people that we've spoken with have said that they're kind of enjoying spending time with the family, especially the lack of travelling either end of the day. So yeah, hope everyone's trying to make the most of it. So what we wanted to run through today is we can go into more detail of this at the end, but a lot of things people are asking about mortgages, logistics, and viewing properties. So we're going to try and cover as much as we can. Of course, the big impact is prices as well at the end. So we'll try and run through as much as we can. We'll skim over a lot of stuff. We'll go into some stuff in a little bit of a deeper manner. And at the end, if you want to go into something more specific, we can of course do that. So as I say, we're going to run through the logistics side, some regulations that we're seeing from the mortgage brokers, the impact that we foresee these things having on the property prices, and as I say, we're going to cover everything from viewing now to not being able to view, buying off plan, not trying to buy something that's ready now, rules about getting a tenant, what if that tenant doesn't pay. So we'll run through as much as possible. So without further ado, let's head into the logistical side of things. So the logistics, what we're seeing at the moment is the reality is that the residential market, whatever anyone says about, oh yeah, the residential market is, people are still going to be moving, that is going to be slashed. And I think I've said this on a previous webinar that Zoopla predicted that the residential market in terms of sales taking place could fall by in the region of 40%. Again, my stance on it is you're probably looking more like 80 to 90%. The reality is if no one can get out and view, or no one could, or an estate agent, a traditional estate agent can't get out and do a valuation, then the reality is the lack of valuation means the properties don't come onto the market. Lack of viewing means that the properties don't sell. So for the residential market, which is not our market that we're aiming at, but the residential market for me is more like an 80-90% slowdown. Now, what then happens is once this lockdown's over, now there's already been talk of come the end of the next sort of 3-4 weeks, so maybe mid-May, some restaurants and cafes will start to open up, but they will halve their intake, so they will halve the amount of tables in there, therefore trying to keep this social distancing going. So there's talk of that, but really from an economic point of view, we need to get going, because although the property market is strong, and a lack of sales doesn't mean, in this instance anyway, a lack of sales doesn't mean that the property prices will fall. It just means that nothing will change. They won't go anywhere. So what needs to happen though, on a wider view, is the economy needs to get going because people need to make money. So in terms of the viewing, the property viewing, well, the reality is that I've known some agents who are literally dropping where there's a vacant property, they're dropping keys outside. Clients are picking the keys up, they're viewing the property, and then they're leaving the keys outside and walking away. So there are a small number of property viewings taking place from the investment side of things, but in reality, where a property is already built and there's either there's a tenant or a living owner in that property, the viewings aren't taking place. When it comes to the off-plan side of things, well, the property viewings, it's irrelevant anyway. You're not viewing anything. But if you've got someone in there where there's a tenant, simply the answer is that the property viewings aren't taking place. So what we need to do is we need to find ways around it. We've on a lot of the developments that we have that are ready now, we've been in, we've taken pictures, and more often than not, what I say to clients is this is an investment. Now, we deal with a lot of clients who are typically first-time investors, and they build up a portfolio with us. That's the majority of our clients. We have some clients who come to us and they want sort of 15 to 20 properties at a time. But the majority of our client base are people that come to us and they are on their first time investment looking to build up a portfolio. What I would say is there's an infamous saying where they say act as if. So if you want to be a big player in the property market, you've got to act like the bigger players in the property market. Now, although that the funds might not be in place just yet, what you've got to do is look what the bigger players do. They don't go and view the properties. The reality is it matters not to them what condition the property's like, as long as it's not some absolute rundown property, of course. But for them, it's all about two things. It's all about the area that you're buying in, because that's key. So area that you're buying in, transportation, and importantly, you're also got to look at things like crime rate. So this is what we would do for you as well. We will look at crime rates. For example, if you've got a particular area where you've got a stunning property, but you step outside and you've got a high chance of either being mugged. There was one property that an agent is selling in Liverpool, and they've got some of the crime in the area is sexual crime. So you're going to find that you're not going to get a female client, tenant wanting to go and live there, because it's notorious for this type of crime. So these are things that we look at on a regular basis, and these are things before we even move with a property. We will look at crime rate in that particular area. But the things that we will also look at are, of course, the transport links, what the rents have done over the past few years, what's happening in the next few years rental wise, of course, supply and demand in that area for rental. So actually, when it comes to viewing a property for investment, the answer is you probably actually don't need to. A lot of people get caught up, and we have clients that turn around and they ask for certain furniture packs. There's a few clients in particular, and they say, well, we want to spend treble the amount on a furniture pack because it will look nicer. But that may be the case. It may look nicer, but spending treble the amount on a furniture pack isn't going to get you the kind of rental that is warranted to pay that extra money on a furniture pack. So what we'll always say to people is, viewing a property, it's pretty irrelevant. We do understand people, especially first time, they want to go and see it, but more often than not, if it's ready now, the key to it is the area that you're in, the supply and demand of rental properties in that area, and of course the crime rate. And that's something that we've already done the checks on. So logistically, for any of those people that are looking to invest, viewing the property is something that doesn't actually need to take place. Once we've established that the property will rent, what we then have to do is we then have to look at the growth side of things. But to establish whether a property will rent, we simply start from the ground up. What we do is we look at when the last opportunity came in the area that was rentable, and we look at how quick that rented. So for example, if something was advertised on the 2nd of January for rental and it hasn't rented until over the last week or so, we know that pretty much either that particular property is being outpriced or it's just not a very good development to rent in. So what we look at as well is how quick things go. Now, we know these areas, we're renting in these areas day in, day out. Typically, for example, we've got projects in Manchester. If we put something online, within a few days, it's already rented. We typically have one advert can generate us in the region of 25 to 35 instantaneous hits on inquiries. Liverpool's pretty similar. We get a huge amount of inquiries because in Liverpool, as the developments progress and they start to get better quality, people want to move up the scale. So again, once we've established the rental side, we look at the growth. Now, what we then start to do with the growth side is we look at market value now. Now, we know that we're in lockdown, and we know that a lot of people are reading reports that the property market might fall 15, 20%, but I'm going to come back to the pricing at the end. But typically, those reports are unfounded. And I'm more than happy to go into this deeper on an individual level if you would like to. But one thing that I do with a lot of clients is if they ever come to me with a report that says our property price is going to fall 20 or 30%, I ask them, first of all, have they ever found that before? Has that ever happened before? When was the last time that the property market fell 30%? That's the first thing, and the answer is it hasn't. Even if you go back to the worst liquidity crisis that we've faced in recent times, 2008, it didn't fall that much then. It fell 16%, it didn't fall 20%, it didn't fall 30%. And a lot of the reports coming out, they're rehashed. So we went through something with a client the other day, and we saw in 2001, one particular newspaper published a report that property prices were going to drop 20%. In 2002, they published a report that it was going to fall 30%. And ironically, 2001 and 2002, the property prices rocketed after that. So a lot of these, again, we had a lot of this during Brexit, a lot of these are just people touting out that property prices are going to fall, and actually it doesn't actually come to fruition. The way it falls is fundamentals, but we'll cover more of this towards the end. So what we look at is we look at the value of the area today. So we know that the value of the area by previous sales, that's a standard rate. Forget about what people are selling for, it's the sales. You can have a property on the market for 300,000. If it's not selling, then that's not the value of the area. So what we look at is the previous sales. So for example, we've got a project in Manchester. We know the previous sale, excuse me, the last sale has gone through at 249,000. So we know that that's the market value for the area. So what we will then do is we will try and get something below market value. So for example, everyone that's turning around saying, well, the property market might drop 10, 15, or even 20%, it becomes irrelevant because you're covered. If we can get something 20% below market value, even if it did drop, which we don't think it will, but even if it did, you are covered. You will still get something market value. Now, the next question that a lot of people are saying is they're saying, well, actually, if the property market, if you're getting 20% below market value now on a property, and the property market then falls 10%, will I get that property cheaper? That's what they're waiting for. They're waiting for that to happen to invest. The answer is you won't, because developers still need to make a profit. Very few developers are going to go and sell their properties at a loss, so they'll simply keep them and rent them out. Most of these people, if they have mortgages on those particular units or mortgages on the development, they can cover the cost of that by renting them out, so they'll just keep them. And that's what a lot of good developers did back in 2008, 2009, rather than selling them off cheap. Now, there was a lot of cheap property at the time, but the bigger guys, rather than selling them off cheap, they kept them, and they become big holders of property, and then they sold them at a time when they ticked back up in price. So the chances of you trying to dip in at the low are pretty slim. If we look at things like the FTSE, you don't see the daily fluctuations that the stock market does. The property market is a more stable, albeit slower moving, investment vehicle and commodity than the stock market. You could easily make more money in a week in the stock market than you can in a week in the property market. But on the same token, you can't lose as much money in the property market in a week that you can in the stock market. So we've seen 30% dips in the stock market, and we also saw after America announced their stimulus, 15, 16% increases. Again, you don't get those kind of fluctuations, but again, there's many investors who actually don't want those kind of fluctuations. They want the stability. So what I always would say to people is, look how long you're going to be holding the property for. So the majority of you, if you had an answer, and if you had to give an answer on how long you're going to have the property for, forget about the current disruption we find ourselves in, forget about any political climate, the majority of you would say probably minimum of 5 years. So the reality is you have to look at a time frame and how property has performed over the 5-year periods, and very rarely have we found a period where it's dipped over a 5-year period. You may have bought in 2007 and it dipped in 2008, but then it came back up. So what I want to do, guys, is I'm going to run a poll. We haven't done this in a while, so it should flash up. So I'm going to run 4 polls, and this will lead us on to the onto the next part. So this is for you guys. Are you looking to invest your money? Because some people are looking to invest now, some people aren't. So you should be able to see that poll. So people are still voting. Let's have a look. So this is how you guys polled on that. So we've got 92% said yes, 8% said no. Now that comes on to the next poll there, guys. So let's have a look at this one. So this is what investment instruments are you looking into? So again, we have clients who are looking all over. We have clients who are looking at sort of property, by the bonds, FTSE, and so on. So there's multiple choice answers. It doesn't have to be one on this one. You can have multiple choice answers on this one. Some people are still voting. So okay, let's show results. So again, you can see that the majority, all that voted in looking to invest in property, but there are other things there as well: ISAs, funds, bonds, and the FTSE. Typically, I'm guessing, guys, the majority of you are looking to invest in the bond side of things due to the safety. Of course, you get government bonds, low returns, but obviously very safe. So what I would always do is, again, I can't comment on the FTSE market and tell you where's best. Again, that's for someone who's qualified to advise you on the FTSE. But what I would say is look at what you're getting in for. If you're getting in for quick gains, I've got no doubt the property market probably isn't for you. If you're looking at shorter term gains, then you're probably best to go into something like the FTSE. But if you're looking for a bit long-term income and long-term stability, typically the property market outperforms that. In terms of the next thing, why haven't you invested yet? This is a key question, guys, that a lot of people find that there's a number of reasons why they haven't invested. So typically, let's see what you vote for first, and then I'll let people know what the majority of answers. Okay, the poll says the same thing. Okay, so show you the results. So yeah, so typically waiting for the current disruption to be over, that's one of the biggest things. We've had a huge number of inquiries, but typically the majority is the fact that people are waiting for the disruption to be over, and then of course that follows on to, I think I can actually then buy a property cheaper, which is understandable. If you know, people that are reading newspapers, they think they can go and get things cheaper, it makes sense to wait. If there's genuinely a chance of getting something cheaper, it 100% makes sense to wait. But the idea is that if you go to a traditional estate agent, you probably are best waiting, because the chances are that there may be some deals to be had. However, the reality is, what I would say to people is that if you find something that's you know, 20% below market value, you're gonna be better off moving with something like that. So let's go to the last poll here, guys, where you would like more information, and then we can start to dictate the webinar from there. So some people want more information on the virus, some people want the ease of getting a mortgage. So let's see where you guys would like more information, then we can go from there, guys. Okay, so we're here. So the majority of you want more information on how the virus can impact the market and the advantages of disadvantages of waiting. Mortgages we'll cover in a minute, guys, as well. So back to where we were. So in regards to the next step, you still have a choice. If you want to view something or you want to travel to an area, well, you're probably best going off plan. If you feel that there's something that's ready now, but you can't go over the line because it's there and you have that impulse to view it, then okay, so there's still options. So we then come on to mortgages. Now, this is a tricky area at the moment, because mortgage rates, although mortgage rates or interest rates, I should say, have decreased, they put an emergency change of an interest rate on. Actually, there have been a couple of mortgage rates that have ticked up. Now, the reason being is typically because of the fact that there's been a less of a choice of mortgages. So just to give you an idea, at the start of March, buy-to-let mortgages, you guys had a choice of 2,897 mortgages. So 2,897 mortgages. That's how many options of mortgage you had to choose from. At the end of March, that dropped to 1,593. So you had a huge drop of approximately 1,300 mortgages were actually taken off of the market. Now, what the reason being is the mortgage lenders, two things happened. First of all, is everyone wanted to go on a mortgage holiday. So a lot of their staff were dealing with mortgage holidays. So this 3-month holiday where you can speak to your lender and say, right, I want a 3-month holiday, they can't deny it, and that puts you on holiday. So the staff, first of all, was taking up huge amount of waiting hours, trying to get through to the banks dealing with that. That was the first thing. So they said, you know what, we can't take on any more mortgages whilst we're doing this. Secondly, there's nothing stopping you getting a mortgage today and then taking a holiday tomorrow. So banks were reluctant to start to sort of lend mortgages until they sort of caught up with the legislation, because the reality is if they start to lend you 200,000 today, tomorrow you phone them up and say, I don't want to pay for 3 months, and they legally have to do it. So a lot of mortgage lenders, Halifax, TSB, Skipton, they all backed out of the market initially. What they then said is they said, look, we'll accept people with 40% cash, 60% loan to value. And then they've now started to come back. So although it's going to take a little bit of time for lenders to come back, we've seen it already. Skipton have already come back and said that they're putting the number of the products back on, if not all their products back on. TSB, similar. So what's the solution? No, if you're buying off plan, it's irrelevant. It's an irrelevant situation. But if you're buying now and you have something that's ready now and you are looking to get a mortgage, well, what you have to do is before you go into that contract, we will negotiate an extended time with the developer. A lot of the developers that we use, if not all the developers we use, totally understand the current predicament. They know that valuations are tough, although these valuers can still do a desktop valuation by going on and seeing what the last price is sold for. So there are ways around it. But we know that if lenders and valuers can't get in to do their surveys, then it might be a bit tougher. So they totally understand that there were going to be time constraints, and you guys might need a little bit more time, maybe another month, maybe another 3 months to actually get the process going. So all the developers are aware of that and they've got no issues with that at all. So that's the first thing. But again, it all comes down to dealing with the right developer and ensuring that that we deal with the developer, which is where we come in, and we help with the communication between you guys and the developer. Because more often than not, I'll be honest, a solicitor, they just literally say, you've got to complete, and that's it, tough, you've got 28 days. So the best thing to do is come to ourselves. We will negotiate with the developer, because all the solicitor wants to do is they don't want the case. They're getting paid a flat fee. They just want it done and on to the next. So come to us, and we've got more chance of speaking to the developer direct and getting an extension than the solicitors have. So we're more than happy to help with that. As I mentioned, in terms of the lending side, a lot of these companies are coming back to the market. A lot of the lenders are coming back to the market, and because of that, then lending will start to get back. This is how banks make their bread and butter money, by getting savers' monies in and lending the savers' monies out in terms of mortgages. So what happens is they're just simply making the difference between the rate that they lend and the rate that they have to pay to savers. It's as simple as that. That's how banks are making the majority of their money. So what you guys have to think about is banks still have to make money. So this market and this short-term disruption that we're having will eventually get over. So it then moves us on to prices. Why are you waiting to buy? Now, like we've basically said, if I go back to that particular poll, why haven't you invested yet? The majority of people there said that waiting for the current disruption to be over. Now, what we say to everyone is, if you're waiting for the current disruption to be over, the chances are is when you've got disruption, you can actually get far more sway or far more leeway in terms of deals. So we're not saying that you can just go in and just, we had a client a few weeks ago, it's 250,000 property, and they bid 150 for it. Things like that won't happen. We're not in that kind of market. However, the reality is if deals are slowing down, then now's the time to strike. You want to strike while the developers are willing to put the deals on, because when the disruption's over, you're behind the curve already. Everyone's already purchased. Developers are turning around saying, well, do you know what? I don't need to put on any offers anymore because we're back to where we were. So you're waiting for something to finish, and you're actually not going to be saving any money. That's the brutal reality. And then the only other thing that is, you think that prices are going to fall so much that you're going to get a huge amount of discount. But again, we'll go through prices in a bit, and the chances of that happening are really slim. In reality as well, what you've got to look at are where people are putting their money. So for example, I spoke to a number of clients about this over the past few days. Commercial property. Commercial property is a great investment for investors to get a regular return. However, with what's taken place, companies are looking at their bottom line. If you've got companies that are looking at their bottom line thinking, do you know what, we've had a really good experience with people working from home. We actually don't need that 10,000 square foot office. We could probably scale down to 2,000 square foot, save 80% of our costs, and we have a rotating system where people can drop in when they want to. I think we're going to find a lot of that. So I think we're going to see a lot of commercial property become empty, where companies, big companies as well, are looking to save money, because the majority of people tend to find they actually can work from home. So unless you're in a place where you need to be in the field, if you can work from home, I've just got a feeling that you're going to have a lot of companies turn around and say, do you know what? If we can save, bottom line, if we can save one of our largest costs, so I'm guessing staff will be one of the largest costs, and then comes down to leasing of premises. If we can save that as a cost, great, we'll get more people to work from home. So, and I think we're going to see a lot of that. So people that in the commercial property sector will look at the actual residential sector to invest in. People that are in the FTSE, we've now had a lot of people who are coming up to pension age. They want stability, they want regular income. They're looking at the residential market. So in terms of waiting to buy for the house prices to dip, just genuinely don't think it's going to happen. Now we go back to the fundamentals. The fundamentals always are straightforward: legislation, taxation, and then mortgage rates and liquidity. If they're not affected, so we've seen liquidity being affected in the sense that we saw banks stop lending mortgages for a few weeks, and of course we saw the property market being affected. If that went on for a year, 100% we would see the property market being affected, but we know that that's not going to happen. So the common three that we've found is people wait is they feel that the property market will drop, they can make more money in an investment outside of the property market, and they wait to see what else comes to the market. Now, if we take the middle one, can make more money in another investment outside the property market, probably yes. In the FTSE, if you're really good at investing, day traders making, depending on what their starting balance are, but you can make tens going 100,000 a day, no problem at all. But then you've got the risk side to that as well. So we really have to take the first and the third one. Waiting to see what else comes to the market. Again, you can always have that. So for example, if you pass on one now, you wait for the next one. Well, why are you waiting for the next one? Why don't you wait for the one after that or the one after that? There's always going to be a reason to wait. And the chances are you're only going to benefit. If you do benefit, you're going to benefit by 0.5%, 1% at best per year over the whole 10-year period. In the whole scheme of things, you're talking about small margins. So I would typically say you're more at risk by waiting to see what else comes to the market. However, if we head to the property market will drop. Excuse me. Let's head to the property market over the years. So if we head back to the 70s, now some of us unfortunately are old enough to remember this, but if we head back to the 70s, this was the average property price here at the bottom. So we had an average property price of £10,000. Margaret Thatcher came in 1979. The property price on average at the time was 17,793. Now we can see that the property prices just kept increasing. Now, although you might think, well, actually that's only a few £1,000s, well, percentage-wise, £3,000 on that is a lot of money. So what you've got to look at is the property prices kept increasing, and all the while we had, this is only a skeleton, but all the while we had these issues taking place. So for example, let's zoom in just in case you can't see it. So we had issues taking place. So for example, we had, the Falklands War, prices still went up. Then we had the miners' strike, prices still went up. Black Monday, stock market absolutely got hammered. Black Monday, prices still went up. Then we have a fundamental. The reason why this is highlighted is because this is a fundamental. Interest rates hit 16%. Now, for those who weren't around at the time, to think of interest rates at 16% now is just unheard of. But a fundamental changed. Because a fundamental changed, the property prices started to reduce. So we can see the property prices started to come down. People simply could not afford their mortgages. It's as simple as that. They then started to hand back to the point where if you defaulted on your mortgage, then it didn't have the same implications as it does now. So people could default on their mortgage and effectively buy a house down the road for cheaper, a bigger house cheaper. So that's what they were doing because it didn't have the same implications. But through this time, then we had John Major became the Prime Minister. We had the initial First Gulf War, had the Bosnian War started, and then we had Black Wednesday, where there was a big run on the pound. And then the prices started to move up. Tony Blair becomes Prime Minister. We had the Kosovo War starting. We had the Twin Towers, and all whilst this happens, you can see prices increased. Then we had the dot-com bubble here. So this is the dot-com bubble burst. This is where, again, one of the biggest stock market crashes from 99 to 2000. Again, house prices were still increasing. Second Gulf War starts, 2003. house prices still going up. London bombings, house prices still going up. Then we had a fundamental change just here, 2008. The reality is banks couldn't lend, they didn't have the money. They couldn't lend because typically everyone defaulted, well, a lot of people were defaulting on the cheaper mortgages, handed back their keys, so they had a load of property but no liquid cash. So what then happened is the government had to bail them out and it got things moving again. So this is probably where we had one of our biggest dips from £30,000 difference between that. But still, we're not talking about 30%. So we're not talking in the region there of sort of £60,000 dips. And that was probably one of the worst times that we've ever had property market, but we're not talking about 60 grand drop. So then we had David Cameron become Prime Minister and the property market then started to head up to where we know it. It took a little bit of time, but don't forget, if you got it in 2010, you may have not experienced much growth during those particular 4 years, but you would have been getting income on a regular basis. And the chances are the majority of you are going to hold for 5 years plus. If you guys hold for 10 years, or if you guys held at 149 on average, don't forget, guys, some of the prices are more, some less, but this is an average price. 149 up now to 212. So suddenly you're making, give or take, in the region of 30% on your property price over 10 years. Plus, on top of that, you're making 5-6% income over 10 years. You're making 90% to 100% over a 10-year period. 10% a year, that's better than the majority of what people are doing in the banks. And of course, we've had Brexit, with where newspapers were reporting huge losses going to be had in the property market. It didn't happen. So again, guys, what I would typically say is in terms of the property prices, they're unlikely to fall unless a fundamental changes. So unless a fundamental like liquidity, taxation, or we see interest rates suddenly rocket up. So most of the time, and I say to people, and of course it's easy for me to say, I'm in the market, I'm in the property market, I've been in nearly 20 years, so it's easy for me. When you're doing this for the first time, it's always a little bit more nerve-wracking. But what I would say to people is, look, anyone that's waited, look at the people that waited a year ago, look at the people that waited 5 years ago. And we've got clients on our books that have been with us for nearly 10 years now, and they're still waiting for the right opportunity. They should have got involved 10 years ago. They would have had, that 100% that we just spoke about. Instead, if inflation has just eroded their money away, and typically now, whereas they could afford to buy in London initially, then it was they could afford to buy in Manchester, then Liverpool. They now can't afford the three major cities. Their money is just eroded away. They've been eating into their savings and it's been dropping back. So what I want to do, guys, is hand over to you. So a few ways we can do this. You've got some questions, and you've got a question mark or a speech bubble on the right. You can also put your hand up. I think, guys, there's a way to put your hand up, and I can see if I can unmute your microphone. I can do it entirely up to you guys, whatever works. So I've got here, the first question I've had through is how many people in the poll? We've got 97 people attending. It doesn't tell me how many of those 97 have voted, but just to give you an example, we've got 97 people that are attending. How about the expat mortgage market? That's a really good question. That's a whole new, a whole different webinar, basically. However, what I would say is that the expat mortgage market is they're going to be a little bit more tentative at the moment. You probably want to have, for an expat, I would say you probably want to have about 40% cash, 60% loan to value, and then you should be okay. So if you're going for something today that's ready now, I would definitely be trying to speak to your broker and negotiating a contract, and trying to ensure that you get some compensation in terms of, or dispensation, I should say, in terms of leeway with time, because the expat market is going to be a little difficult. If you need help, feel free to email me. Let me see if I can change my screen at the end. Feel free to email me, and I can put you in touch with a few brokers who specifically deal with the expat market. No problem at all. Neil, I've got your hand up, buddy. I'm going to try and unmute you. Bear with me, and it should go green, my end. I don't know if it has. Neil, I don't think we can hear you, mate. Neil, sorry mate, you might have to write out a question. Apologies, I've tried to unmute you, but it's not actually coming through. So if you write the question, I'll answer it for you. Next question. I'm due to exchange next week. I'm very skeptic if I should go ahead now because of the pandemic. Can I renegotiate the price or abandon losing the reservation fee and look for another property at the bottom price later? Again, I don't know your property in particular, but I would say if you've got it below market value, I really wouldn't start to worry about the current disruption that we find ourselves in. I genuinely don't think that you're going to see a reduction in prices. What we've got to look at as well, and this is one thing that we've not touched on, is in terms of rentals. A lot of people say, well, what if people have less money in their pockets, which is a chance that can happen. If the economy suffers, which it will no doubt suffer from being closed effectively for 3 weeks, if this goes on for another 3 weeks, which I think it will, then it will have 6 weeks of suffering, and then I think we're going to bounce back. But let's say it continues, then the economy is going to suffer. So what happens is people still need, and this is what people forget, people still need to live. People still need a roof over their heads. So what happens is typically people are eating into their savings because now they're using up their savings to actually live rather than building up savings from work. And if people are eating into their savings, less people can buy a property because they don't have the savings. So what happens is more people rent. So it puts more pressure on the rental market. Typically, whereas people may have rented on average for 18 months to 2 years, saved, and then moved on, you'll be looking at 3 to 4 years rentals. So what happens is that client doesn't move out of your property. They're still renting. They're still paying their rent. And then what happens, that puts more demand because the next people that are coming through to rent, they've got nowhere for them to go. So what happens, that pushes the demand on rental properties. Therefore, more people are buying rental properties to let out to make money. More properties get sold, prices go up, and so the process goes on. So actually, if you do a bit of just basic research on what happened to the rental market in 2008, 2009, actually those next 5 years were more so in demand for rental properties than they had previously, because people couldn't afford to buy. And that looks like it's going to be the case again. So what I would say is, I wouldn't, again, in terms of renegotiating your contract, I don't know who you bought from or anything like that. So without specifics, I can't help you there. But what I would say is, I genuinely don't think there's anything to worry about. The fundamentals haven't changed. The property market is going to be more in demand than ever due to people wanting to put their money in a safer place. The rental market is going to be more demand than ever because people need places to live. So I don't think you're going to have any issues whatsoever. Okay, next question. What's the impact of CV19 on residential developments under construction? Again, good question. So it depends on the developer. So for example, if you've got a developer who has staff members that are the builders, the contractors essentially, so the plumbers, the electricians, they're still going to have to be paying them essentially. A lot of those guys work on sort of week to week and hand to mouth. So what you're basically looking at is a lot of these companies will either lose those staff or they would just keep having to pay them. So a lot of the bigger companies are the ones that struggle. But a lot of the sites that we're dealing on that were already underway, they're still carrying on. As long as there's no family on the site, they can still carry on. So a lot of the empty buildings, as long as they're keeping social distancing, the workers can carry on. In terms of developments that haven't started yet, so let's take St Anne's for example. Well, they're not going to start. They're not going to start now because the issue that you'll have today is getting materials and getting things like cranes, diggers to site. So all they're going to do is they're going to delay it. So it doesn't have any financial impact at all because the construction is outsourced. So they're not actually paying. Now, if they were paying for their construction or their constructors and they were not doing anything, I would have a slightly different slant on it. I would be more concerned. But the fact is they've got the money that they need to build. They don't have to do any sales to build. So there's no impact on the build as a whole. Will there be impact on the actual completion date? At the moment, no, because we've already legislated for a form of delay. So we've already added 4 or 5 months plus into the equation because we always do, because we always think that there are going to be slight delays. Worst case scenario is if this carries on for another 6 months, okay, there'll be a 6-month delay on it. but I genuinely don't think it will. People need to get back to earn a living. I don't think there's going to be any impact on construction at St Anne's on the whole. We know that there's a short-term impact because the materials aren't there and the transport isn't there. But on the whole, absolutely fine. They're not paying out. They've not cost any money or anything like that at all. Got another question here. Would you say it's better to buy something ready now or something that's off plan? Again, it really depends on your personal circumstances. If you're someone that wants income now, then you know, okay, you can go and buy something now. Depends on your mortgage situation. If you're cash, if you're mortgage, there's so many variables. What I would say is the key to any property investment is the price that you get it for. That's it. If you get it for below market value, you're winning from day one, and that's the key. That's why I always say to people, a lot of people who look locally, and a lot of first-time investors do this. They look locally, and they turn around and they say, "Well, I've gone to a local agent, and I want to invest locally," and they'll go to just a normal traditional agent, and that particular agent will sell them something that's market value. All you're doing there is you're putting your money into something that can give you an income. You're not really going to generate that big spurt of growth at the start, and that's what you want. And that's the difference between a traditional estate agent who will go and value a property at market value and then sell it to you, or a company like ourselves who will go and value it at market value, drive the price down from a developer, and then advise you to buy it, because that's really what we need. Callum, bear with me, buddy. You got your hand up. Let me see if I can unmute you. Callum, you should be good to go.
Yeah, hi Chris, can you hear me? I'm just wondering, because you said that that the developers at St Anne's they're not doing the actual construction yet. But I'm just wondering what stage you're at now, because like I said, it was quite a few months ago when I agreed to go with this St Anne's, and you were doing like the office work then. So I'm not sure what stage you're at now and how long it should take. Or when will they move on to construction?
Yeah, good question. So nothing's changed in terms of the actual completion date, Callum. We still, Callum, by the way, sorry if you start talking again, I've muted it so there was no feedback. So just put your hand up again if you want to interrupt. So yeah, in terms of the completion date, nothing's changed. We've already stated that it's going to be Q4, 2021. So December 2021. That's going to be maintained in the contract. So that will be the completion date. December 2021. So nothing's changed from that. They think they can get it done by the summer. We've added, as I say, an extra 4 or 5 months plus onto that, because we know just from history that things always take a little bit longer than developers expect, hence why we've added time onto that. The reason why we got a lot of people into St Anne's early wasn't due to the fact that they were going to be building imminently. It wasn't that. We anticipated end of Feb, beginning of March for start date on site. The reason why we got people in early was to secure the price. So in terms of the prices early, we were talking about 1 beds for 106. Those same units now 122. So by getting in early, yes, you've had to wait a little bit longer, but you'd have had the money just set in the bank anyway. So anyone that got in early has actually benefited from prices. I mean, studios were 75, 76 off the top of my head. 1 beds were 106, 2 beds 160 odd with parking. We're now talking about 1 beds 122, 123, 2 beds 180, 190. So the reality is that we got in early for that reason, not for any other reason. Now that that's done, now the prices have increased. Yes, we did expect them to be on site now, but of course this is a time when they physically can't. Even if they wanted to get on site, they just don't have the materials, because people aren't, the bigger building merchants aren't delivering the materials, so they'll just have to wait. But that doesn't mean that there's a problem or there's an issue. They'll get on site and they'll go for it and they'll get it done. And as I say, Callum, we still expect it to be the same time that we gave you back in December, January, when you moved with this, is the same time that we believe it's going to be done now. So December 2021. So I've also got a question here: is am I likely to hang on a sec, wrong way around words here. Am I likely to have an advantage to waiting until this has died down another 6 to 8 weeks? Depends on the development. So if you've got a development where you've got, for example, 200 units in it, the developer's not offering any form of discount, there's no deals to be had, and the prices aren't going to increase, well then yeah, there's no reason to buy now, is there? Let's be realistic. You've got no incentive to buy now. The reason people should be getting involved now is to take advantage of the disruption, because everyone reads about it. If you look at the papers and think, well, I wonder how that's going to affect me, think how a developer feels. You're potentially putting in 100 to 200, 300,000. They've got 30 million on the line. So it's time to squeeze them. And it's, you know, I've picked up more properties in the last 4 weeks than I've done in the last year, just simply because of the amount of bargains out there and the amount of deals out there with developers. And you can squeeze them. And you know what? The best thing is you turn around to a developer, you ask them the best price, they give you it, and you say no. And then the developer comes back and they'll come again, because the developer wants sales as well. And as long as you've got that property below market value, doesn't matter what happens, you're going to be absolutely fine. And as I say, you know, let's go worst case. Let's say, I don't think it's going to happen, but let's say it does fall 15%. The reality is you're not selling now anyway. Like we've demonstrated on the property prices, you're never going to get in at the bottom. Otherwise, if you did get in at the bottom, the people that are old enough to remember it, you would have bought in 2010. I can guarantee the majority of you didn't, because of the reality is that you were probably unsure. And therefore, however, if you did buy in 2010, you'd have made a great gain. Another one here. There was a similar property in terms of size and price very close to the one I'm planning to buy, which is now 10% discount. What are the chances of having a similar discount on the price match, or at least just for exchange? Again, I don't know the particular development or developments in question. It's very difficult to say, well, we've got one building here which is 200 and one next door which is 180, 10% discount, for example, because you may have two buildings that are close to each other, but for example, one might have a 250-year lease and another one has a 50-year lease, or one the service charge is 1,000 and one the service is 3,000. So suddenly you've got to look at why are they offering a 10% discount. What I suggest you do is, if you email me directly, I'm more than happy to take a look at the two properties. But look, you can only ask. If you're concerned about what you're paying, then of course go back and ask. The chances are is if the developer wants to do a deal, and if you've paid market rate for something anyway, the chances are you should be asking for a deal anyway. If you've paid exactly what the market rate is, yes, you should be applying for a deal. However, if you've got a discount on it anyway, you know, it's going to be much of a muchness. But what I would say is, without knowing the two properties, it's very difficult. We have a lot of clients who say, oh, I found something around the corner for 10% more. Again, and then suddenly we look into it, and actually you've got service charge, which is 3 times as much. You've got, you know, a lease which is going to cost you money to extend. And so suddenly then there's added costs and implications to that. So I was speaking to someone earlier, and there's a property in Mayfair for 500 grand. Normally there's 16 million, but when you look at the contract, there's only 1 year left on the lease. So you've got to pay millions to extend it, because it's down to 1 year. So actually you're just renting it for 500 grand. So it's you know, it's a fallacy. You've got to look behind the detail. Callum, bear with me, buddy. Got a hand up again. Callum, you should be good to go, buddy.
Hi, Chris again. I'm aware that I'm going for St Anne's property, but I'm wondering how many of them properties have been like going for, because I know there's 25% of that money we've got to pay as a deposit. So I assume that the developers will need that money to get the materials. But if we don't have that, if they don't have that money, then they won't be able to fund for it.
No, they like I said, they don't need your money to build. Like what you've got to look at is how much of that money. So for example, if you've got £100,000 property and they've got 25,000 of that money, well, let's say they have that 10 times, so 250 grand. Well, let's say they have that 50 times, so you've got 1.5 million. 1.5 million is not even going to touch the sides when it comes to building a development. They've got a facility there. They've got a £12 million facility that they can dip into at any time. They don't need your money to build. They can use it. The warranties in place. So you've got, as I've mentioned on a previous webinar, you've got the 10% protection. So can they use it like most developers? Of course they can, but it's not gonna do anything. If they didn't have the loan facility in place, or they didn't have the funding, I would genuinely not been dealing with it. I don't deal with developers who don't have the funding. So they've got the funding in place. They don't need your money to build, even if no one purchased, even if no one else purchased, they don't need that money to build. So you've got no issues with them running dry or anything like that. And as I've always said, a lender is always going to do far more due diligence than you, not only because they want to, but because they can. They will spend tens of thousands doing due diligence. If they're going to lend out 12 million, they're going to spend tens of thousands doing their due diligence, far more than what most people could do just going off research and things like that. So what I would basically say is don't worry about it. They've got the money to build. There's not going to be any issues there at all. Okay, I've got another question here. In terms of properties, what particular areas would you recommend? Are there any areas stronger than other in terms of recession? Yeah, city centre. You've got to go with city centre. You tend to find that you want tenants in. So let's go back to the tenant question. Let's go back to where tenants, you want tenants who can afford to pay. Because if tenants can't afford to pay, then that's when you do have issues. Now, if you go for cheaper properties on the outskirts of areas, typically you don't get the right kind of tenant in. You either have families in there that are living there all the time, and kids. I know with my kids, they draw on the walls. It's why they draw on the walls, I don't know, when they've got enough paper and chalkboards to draw on, but they still go for the walls. So what you want to do, guys, is the reality is get city centre apartments where you've got young professionals. There's more jobs in city centres. In times of hardship, the jobs will still be concentrated in city centres. So by city centre, higher net worth individuals, you've got young professionals in there who will rent for longer and pay your rent. And that's all you want. You want your rent paid to make an income and cover your mortgage. So therefore you've got a regular income coming in, and up goes the price of the property. So yeah, city centres. And then it comes to where in the city centres. Well, in terms of where you want to buy in areas which haven't reached their peak yet, but still on a solid footing, where by tram stops, close to main stations, lower crime rates. Simple as that. All right, guys, well, I think that's it, and I hope that's helped. As I say, if you want to go into things on a deeper level, whether that be about mortgages in particular, we can put you in touch with overseas mortgage brokers who deal with expat mortgages. We can put you in touch with brokers who deal with specific mortgages here. As I say, I think to summarise, lenders will be coming back. I don't think you have any issue there. In terms of the prices, I still feel that they're going up, and I know a lot of you will be thinking, well, I still don't believe it, or I'm still unsure, and I totally understand that. When you're new to an industry and you're reading day in, day out that things are bad and things could fall, typically you read a number of these reports, eventually you believe it. But the reality is you have to look back in time and just see, and we've done our due diligence, and we know how many reports were written in a negative way in 2001, 2002, 2010, 11, 12, right the way through. And if you can just get over that and look at the fundamentals and think logically rather than emotionally, and that's the hard bit, to try and think without the heart, think with the head, and think, why would property prices fall? The reality is, why would they? The only time property prices fall is when there's the liquidity issues and banks aren't lending, say taxation, interest rates, and legislation. They're the fundamentals. So if any of you want to go into a bit further depth, more than happy to do so, guys. Well, take care. Hope you're all staying safe, and I look forward to speaking to you either on the next webinar or if not before. Take care.